Okay, it's 9:33. We seem to have quite a few people now joining us. Shannon, can you hear me okay? Make sure we're all working.
Yeah, can hear you.
Yeah, good, thank you. So I will kick off. I think there's still a few people that are due to join. No doubt they'll join us over the morning and dip in and out as well. So good morning, everyone, and welcome to the BDO annual betting and gaming update for clients and contacts. Counting back, I think this is our 19th year of holding these events, sometimes more than once a year, but only our second virtual event, having beat COVID to it in 2020. Hopefully your families and friends have escaped the worst of the pandemic, and next year we'll see you in person again, although I'm sure that there'll be a bit more of hybrid format for these events going forward. BDO continues to have a specific sector focus on betting and gaming, and we're the only accounting firm internationally to have a bespoke cross-stream team. And we've continued to expand our resources and service offerings in the period, particularly around audit, US transactions, tax services, and also digital and regulatory services. And these are all areas that we'll cover on the update today. I think whilst other firms manage their client risk differently, our sector focus and understanding the sector is the most important to us. I need to mention John Barker. Most of you will know John, and indeed there's a large number of former BDO colleagues on the call today working in the sector. John has previously had responsibility for introduction of these sessions as head of betting and gaming. He formally handed over the reins to me last year in the run-up to his retirement as a partner in July 2021. This is the first formal opportunity to thank John. Unlike Boris, we were not able to hold a party for him last year. John is one of the few advisors who's been focused on betting and gaming spanning 2 centuries, let alone 2 millennia, and his work ethic and his unrivaled experience brings real value to clients and colleagues. But John won't be missed, not yet anyway, as he's continuing as a consultant post-partnership, and probably seen little change since his retirement, given the activity levels in the sector and the large volume of transactions over the last 12 months. So that's continuing to keep him very busy. I'd normally share a Christmas joke at this seminar, but given John hasn't had a leaving speech, I thought I'd just do a short reflection of one of his special skills that will truly be missed. You'll not be aware, John has magical abilities. Of Hogwarts standards. He's not a full-blown member of the Magic Circle, but he has perfected one trick that he's been able to replicate over and over again during his long career. He doesn't even know he's doing it anymore. It involves any form of ticket. On acquiring a ticket, John will place it for everyone to see, normally in his top pocket, and then within seconds, sometimes milliseconds, he can make that ticket disappear. He will prove to his audience it has disappeared by showing them the other 30 or 40 tickets that are stuffed in that pocket, and display each of them to everyone's satisfaction that the ticket has indeed gone. And then, like any great magician, he will show every other pocket and orifice does not either contain that ticket. Only when the whole audience has been satisfied it's truly disappeared, normally 10 or 20 minutes later, will he return to the first pocket and magically apparate that ticket back to the first place where he looked for it. When he does have time post retirement, maybe Britain's Got Talent will have that pleasure of seeing his trick. Seriously, John, thank you. Thank you from all of us. You'll leave a great legacy. So thank you for indulging me on that. We have a packed agenda, so I will press on. Shannon, could you just go to the introduction, the timetable, please? Next one, that's it, thanks. I'm going to update very briefly on performance as usual in the last 12 months. And then David Perry, who's recently joined us as our sector team as an experienced audit partner, will update us on some current reporting requirements. We'll then reflect on some of the M&A activity from Ollie Woodward and Toby Ankers. And then following on from that, Dom Stammers is going to just reflect on some of the US experience. Dom's been very active over the last 12 to 24 months with most of the main transactions that have happened in the US, so just a chance to reflect on that. We'll then have a session on regulatory updates and particularly sort of experiences from some of the work we've been doing with these reviews in the last 12 months with Fiona and Clorinda. We'll have a quick comfort break, let you have a coffee refresh, and need the loo if you need to pop to loo. Only 5 minutes. We'll try and get back as soon as we can. As I said, it's a packed agenda. We'll try not to overrun. I suspect we might, but we'll try and keep to it as much as we can. And then after the break, we'll look at tax matters, normal update with Tim and team, with some guest speakers, Daisy, Liz and Paul again, and then indirect taxes with Martin and Chris from our VAT team. And then finishing off, we've got Fiona Davis and Jason Gottshall just talking through the risk agenda, something that all boards need to be thinking about at the moment. But also, we've seen this on the agenda of various regulators, including our audit regulators, who are looking for controls in that area, and therefore it's impacting your audits. But also it might well be legislated through some of the current consultations. US pretty much expects it, but we've actually seen the HMRC begin to go down that route. So it's becoming more important, and that's the closing session today. So a lot to get through. Timetable is challenging, so please bear with us. We'll try to be done as close as possible to 11:30. We'll pick up any questions at the end of the session. There is a chat function. Please do, as we go through, if you do have any questions, please log them in the chat function. If we have time, we'll do them as we go through. Otherwise, we'll circle back at the end, and if we have time, we'll just pick up on any of the questions that come through. So I'll press on, using up most of my time already. So thank you, Shannon. I'm just going to talk through performance very briefly, and this is the work we do each year for EGR for the Power 50. It is online only, so apologies for those joining who are not solely focused online, but it is the culmination of the performance for those people that have applied in the Power 50. And it does go over quite a few years now, but we do strip people out to make it consistent year on year. So it isn't the entire population, but it is those where we're able to make sure that we've got some consistency. And we'll start on market cap this year. Obviously, market cap is impacted by some of the dynamics and economics that are going on in the world, but you'll see that there's quite a tremendous jump in market cap on those businesses within the Power 50 index. We do put a private company price index type valuation on those private companies, so it is consistent. It does move a little bit with the multiples that are used year on year, in line with actually what we've seen in the listed companies. But a 51% increase in market cap is quite dramatic. I think the comparative at June 20 was perhaps suppressed by some events at that point, not least the beginning of the pandemic. But we've seen a remarkable bounce back, and there's no doubt that the online gaming industry has been a net beneficiary of some of the activity, despite some of the physical challenges in operations and sporting events being cancelled, etc. So standout year. Shannon, can you go to the next slide? We can just have a quick look at what's driving perhaps some of the increase. This is the graph for net gaming revenue. Again, quite a dramatic upturn in 2021 for online. Unsurprisingly, there has been a shift from some of the land-based activities to online in the period, and I think it's been surprisingly sticky. We haven't yet seen a period, a stable period, to assess whether or not the activity is going to continue to be so sticky, but I think it is going to be very positive for the online industry. So 19% in net gaming revenue, from 21 billion to 25 billion on this population. I do mention each year these graphs and some of these statistics are very helpful in the reporting period, I think, as evidence to support some of the impairment reviews and the forecasting that you no doubt will be looking at for purposes of your reporting of 2021. So what about the profit impact? Shannon, can you just jump forward one more? Even more striking, a rise in adjusted EBITDA. This is picking up an adjusted measure for the online businesses, but a 30% increase in performance for adjusted EBITDA is quite striking. the top line is actually EBITDA margin. Looks flat, but actually a very impressive move from 20% to 22%. And we have seen a very steady decline year on year in that particular measure. So absolutely bucking the trend, obviously driven by top line growth and a overall significant cost saving. And so despite the tax increases, despite the regulatory challenges, actually the online gaming industry has had a standout year. And there have been other successes in the recent period in other sectors, but clearly online gaming is going to be one of those standout sectors. Maybe a driving factor for some of the continued transactional activity we've been seeing, but also ammunition, I think, for continued taxation and regulatory challenge and perhaps public sentiment focus on things like receiving furlough monies and the like in the sector, which maybe we'll watch this space as that develops. So thank you for that. As I said, challenging agenda to keep in time. Thank you for participating today. I'm going to pass on to Dave Perry just to look at some of the reporting for the period. As I said, please do drop in questions if you have them. Dave, I'll pass on to you now.
Okay, thanks, Kieran. Thanks for that, and welcome to you all. Hopefully you will forgive me a bit of brevity in this slot, as I'd like to get through a fair few points that may have an impact on the sector. As such, you won't see me going into worked examples or paragraphs of IFRS, which I'm sure will be a disappointment to many. But suffice to say that if anything crops up that you think particularly relevant, interesting, very happy on those details to have a chat about it at a later date. First up, though, if we move on, Shan, to the first slide, from a narrative reporting standpoint, I wanted to update what I think our previous year's seminar covered in part, which was the Task Force on Climate-Related Financial Disclosures, so TCFD, and just advise of progress in that area and the practical implications on your corporate reporting. So I think last year we communicated the principle of the reforms and the requirements, which at that point were purely for premium listed companies with January 1st, 21 financial year start dates. And of course, the inexorable advance of the reforms continue, which means that the perimeter of companies is now extended to all standard list companies as at, I think, the 1st of January 2022. And now on top of that, as you can see on the slide, the UK government have published regulations that require effectively the same mandatory disclosures within companies and groups' strategic reports for an even wider set of groups, and including larger privates, AIM listed, are presented there on the slide. That's a little bit later. That's for the period starting the 6th of April 2022, but reflective of, as I say, a march towards ever tighter regulations and increased disclosure. Having said that, practically, I think the implications of these regulations shouldn't necessarily be too alarming. In most cases, your annual reports would already have fulsome disclosures on governance, on strategy, risk management, as well as KPIs, metrics, and targets, which are actually the 4 pillars of the framework anyway. So the legwork to get to what would be seen as a compliant position, it really shouldn't be that onerous. My observation is that the best disclosures that we're seeing from the first year and early adopters, as well as the ones that the FRC have highlighted as best practice, are in fact reflective of real engagement of the issues within the business, rather than just having it as a box ticking exercise, which is maybe addressed in the 4th quarter of the year as you're doing your annual reports. And also ones that genuinely reflect thoughts about climate change as a fundamental business risk. So that permeates all areas of the narrative disclosures, as well as the financial statements, so provisioning, down to things like useful economic lives of assets and so forth. My final point on this would be to observe that the FRC have served notice that in their next round of corporate reporting reviews, they are going to be specifically looking at TCFD and disclosures around climate change, as well as other sustainability metrics as an area of focus. So couple that with increased focus on this area by the investor community, it is one that probably needs to be high on the agenda and one to put ahead of the curve. Shane, can we move to the next slide? Thanks. So next up, I wanted to brief on financial reporting changes, and good news is on that many for this cycle. I presented the actual amendments to IFRS here. Insurance contracts for completeness. I mean, that'll only impact companies trading with insurance. The
Shannon, is Dave's frozen for me? I don't know. Is it frozen for everyone?
Yeah, he's also froze for me.
Sorry, everyone. See if we can get Dave back quickly. He's actually in our office, so I'm not sure why he's been thrown out. Absolutely life in 2021. Just give him 1 minute. Otherwise, Dom, if you can maybe get ready, we might jump into your session.
I was slightly nervous that you were going to ask me to finish off Dave's
accounting
update session.
I would normally do it myself, but I wouldn't want to do it, take away from him, but also be dangerous to do so this year. Dave's back, so we just hello, Dave.
Hello.
Don't worry, you just dropped out. I'll let you pick up again.
I'm not going to blame our office's Wi-Fi, Kieran. But
yeah, I said you were in the office.
Must have something. Where did I get to, Kieran? Can you just give me a?
I think you'd only just got. So you'd mentioned you weren't going to mention insurance contracts. I think something like that. So. Okay,
perfect. So I wasn't going to mention insurance contracts, and I also wasn't really going to mention IBOR or COVID rent concessions either. Suffice, except to say that any changes that you think may be influential on your accounts will just be to avoid any kind of volatility in accounting. So not a great deal to worry about. In terms of UK GAAP as well, I include that because actually the amendments to IFRS translate through to UK GAAP with an obvious nuance between UK GAAP and IFRS for lease accounting. But the principle remains the same. So the expedient is in place until the 30th of June 2022. Okay, those are the IFRS changes, and now to agenda decisions where it's a little bit more noisy. And these are IFRIC in the Interpretations Committee having a discussion about certain areas and certain potential risks. Whilst it's not a change to an IFRS, it's something they expect to be adopted. The first is the recognition of costs to configure or customize software as a service. And the most common consideration here is whether that constitutes an intangible asset or not. And the key message, I think, for me here is that it's a high bar to be able to record costs related to the underlying arrangement as an intangible, hinging on the definition of whether the underlying resource is an asset, or otherwise whether you can control it, deny the access of others to those benefits, and whether it's also practically feasible for you to be able to take that asset and use it elsewhere, or indeed not use it at all and avoid any kind of penalty, fee, or if you can sail along without having any updates from the supplier or technical support, and all those considerations need to be thought through. There may be, and this is where the board got involved, is circumstances where entities can incur costs to try and customize, make the cloud solution that they're talking about, like Amazon Web Services, for example, communicate and interact with internal systems. And the committee's view here is that, and I'll stick to what their wording is that the software being configured or customized and those activities do not create a resource controlled by the customer that you can separate from that software. And I think their wording was that it's unlikely, and that's actually a pretty rigid wording from the committee. So I think it goes into the realms of being quite rare that would be an option. Exception, there are limited exceptions which should be considered well in advance of reporting periods, where you're potentially writing code independently of the cloud that you're using, and that code is able to be then pivoted and you can use it with another cloud solution. Again, it's, as the committee infers, that's not expected to be widespread. So given the committee's view was published in the first half of 21, I think their expectation would be that's adopted relatively soon. It's fair to say that the application of that, given the 1st December reporting period in the cycle, it is evolving. So again, this is something to put on the agenda with finance teams, just to make sure that if you are touched by any kind of cloud solution or software as a service in general, that your accounting policy is documented and you're comfortable with it. And then finally, a slightly more binary one, which is not actually confirmed yet by IFRIC, but we believe that the direction of travel is that it will be adopted in due course, and it was helpful to brief you, especially because there's a preponderance of different applications of policy in our sector, and that is the recognition of cash, and specifically the timing of that recognition. And the substance of the conclusion is that BACS payments, which are kind of in the post, should not be recognised by the recipient company until such time that they actually have access to that account and the cash, and so they can see the cash in the account and use it to buy things, pay staff, pay debt, and so forth. Instead, these amounts need to be considered as an other debtor, ideally, given that the counterparty is now the bank rather than the customer, until you have freedom to direct the cash as you see fit. And so the reason why this is particularly interesting, I think, is that the committee focused on BACS, but in this instance, but if you follow that through, it kind of permeates other areas of treasury management. So we see that interpretation applying to something like a cheque payment, as I mentioned earlier, or indeed credit card payments and credit card debtors. And where I think, from my standpoint, where I see this impacting our industry the most is around digital wallets. And again, that's not something consistently applied in the sector. I see them as debtors and I see them as cash. But if you follow the underlying rationale that the committee have published, then I think there's certainly a case to consider whether these balances should be considered to be cash deposits, as they do technically, they provide the contractual provisions to use that money as you see fit. As I said, again, this isn't something that's formally adopted yet, but I would recommend that this is part of that agenda to talk with your finance teams about, as well as audit committees, to discuss in good time so that accounting policies can be documented in advance of any kind of formal strictures that are laid down the line. Okay, technical gremlins aside, I think that was the wrap up of my section. I appreciate your attention relatively early on a Friday. I'll pass now to capable hands of Ollie and Toby.
Thanks, Dave. Morning, everyone. If you could just move on to the first slide in our section, please, Sharon. Yeah, the one after this. Thanks. Thank you. So just to give a very brief introduction to the transaction services betting and gaming team in London. So I'm Ollie Woodward, and alongside Toby Ankers, we're going to be talking through some of the M&A highlights from 2021, and also some of the sort of key trends and considerations coming out of our diligence work. Just to give a brief introduction to the team in London, Ian Cooper is the partner heading up the sector in our team, taking over from John Barker that Kieran mentioned earlier. John is remaining with us in a capacity as senior advisor, so continues to be involved in the day-to-day. And alongside myself and Toby, Alex Karski is also a director in the team focusing on betting gaming transactions. So if you could just move to the next slide, please. Sure. Thanks. So doing a bit of a whirlwind tour of M&A activity in the sector in 2021, you won't be surprised to hear that a large volume and proportion of this has been driven by the US and US activity, largely due to the legalisation of sports betting on a state-by-state basis. And what that's led to is large-scale consolidation, really large-scale transactions. And in particular, that's involved transactions where US companies have been acquiring UK operators with a view to increasing their market share, but also leveraging off the expertise of those UK operators that have been involved in the sector for a very long time. So the sort of headline examples of that were Caesar's acquisition of William Hill, Bally's Corporation's merger with Gamesys Group, and more recently MGM's and DraftKings' interest in Entain. Similarly, companies are looking to go down the public route in the US in search of high valuations, and that's either been via special purpose acquisition companies, SPACs. Examples of that were Cadere Online and Betway's parent group, Supergroup. But in other instances, companies are still favouring the more traditional IPO route, and a headline example of that was Sports Radar's IPO in the second half of the year. Despite the large-scale activity going on in the US, there is still a lot of M&A activity in Europe as well. Typically, what we've been seeing in Europe are bolt-on acquisitions, mainly by operators, in order to enter new markets and also new products. Examples were Flutter's acquisition of Sisal Gaming and Tombola, and Entain also acquiring NLabs, BetPT and Unicorn. So examples there. And what we've also seen is that operators in certain instances are looking to bring games development in-house in order to get a competitive edge. One example was Kindred's acquisition of Relax Gaming. And circling back to what I was talking about, the US and the large-scale consolidation there, that's also resulting in some M&A opportunities due to the breakup of those large operators. And an example of that is 888's proposed acquisition of William Hill's non-US assets. Sweden continues to be a very active market as it has been in recent years, and I guess the headline one there was probably Evolution's acquisition of Big Time Gaming. And I guess from a regulatory perspective, so the significant changes that have gone on in Germany and Netherlands recently is also increasing interest in those markets, and we expect that to be something that continues into the next year. And then finally, the countries I've listed at the bottom there, Australia, Canada, and the region of Latin America, they're other areas where we've seen a lot of M&A activity in the year. And probably the standout one would be Aristocrat Leisure's proposed takeover of Playtech, Aristocrat being an Australian company. And so they're all spaces that we'll be watching in going into 2022 as well. So I'll just hand over to Toby now to talk to some of the diligence trends that we've seen in our work.
Great, thanks, Ollie. And hi, everyone. Shannon, could you please go to the next slide? Great. So now turning to some of the key trends we've seen in the industry during 2021, starting with in terms of product offerings, we've seen a significant return and uptick in the sports betting market, driven by the return of major global sporting events that were cancelled or postponed in 2020, the Olympics and the Euros, for example. Also, the opening up of state legislation in the US has boosted the sports betting market, with several of the large US-focused deals that Ollie mentioned being based around those sports products. Secondly, there's been a continued strong performance in the online casino space in 2021, developing on the accelerated performance in the early COVID lockdowns of 2020. This has further been boosted by the overall trend to more mobile usage, as well as the continued development of and investment into social gaming and live dealer offerings. Thirdly, there continues to be a high level of M&A activity in the online lottery product space worldwide. And finally, there's been growth in the number of transactions that include new product verticals, as operators have looked to improve their player experiences through the use of artificial intelligence, to develop new products that incorporate virtual and augmented reality, and to capitalize on the continued growth in the esports betting market. Away from product trends, we've seen continued private equity interest in betting and gaming transactions. For example, Bruin Capital's acquisition of Odds Checker in July, and Hanover Investors' acquisition of the testing and certification agency Ecogra in December. And lastly, after a difficult period with COVID restrictions, land-based casinos were boosted by the relaxation of those rules in mid-2021 in the UK, allowing casinos to reopen and resume trading. There's also been some notable M&A activity in land-based operators, demonstrated by Metropolitan Gaming's acquisition of Caesars European and African casinos. Ollie, back to you.
Thanks. You just move to next slide. So just talking about some of the key diligence considerations coming out of our work. One area that we're looking to utilise a lot more is the use of data analytics in our diligence work. And what that really is all about is betting and gaming companies, in particular B2C companies, obviously harness a lot of data in business intelligence systems or similar. And we now, where possible, want to get access to those systems in order to take that data and really present the key drivers of the business. And there are lots of tools which can do that very effectively, and it's becoming a more and more common theme where we're working closely with our clients in order to do that. I guess one area where we find it gives people a competitive edge is if they are reconciling their operating systems to their financial systems on a regular basis. There are instances where there are rich sources of KPIs and data that may or may not be used in sort of monthly management reporting packs, but are very key KPIs that show the business drivers. So I guess our top tip in relation to that is if operational systems are being reconciled to your financial systems on a regular basis, it can give you a real competitive edge in an M&A transaction in terms of presenting those kinds of data. And another area which we continue to see being very hot topic in diligence transactions is obviously the impact of COVID-19 on EBITDA and working capital, and trying to unpick that. In particular, it can be very difficult in relation to revenue. So if we take online casino, for example, the last 18 months, online casinos seen a lot of exceptional growth, and that's partly been due to the migration of land-based players to online. And the key challenge and interesting area in relation to looking at underlying EBITDA is how sustainable that player migration is. And going to the first point I made around looking at the data analytics and KPIs, we've been looking at player data in a lot of depth to try and understand that sustainability. And initial trends have shown that in a lot of cases it has been. And I think that will continue to be an area of interest, seeing how that growth sustains itself into 2022. With regards to sports betting, the challenge has been a little bit more difficult due to that stop-start nature of the sporting calendar, events getting cancelled or postponed. And the challenge really has been trying to understand what a normal year would look like if those sporting events would run as normal. So when we've been looking at underlying EBITDA, it's been trying to piece back together what a normal year looks like. And again, that's been a topic of debate when we're looking at EBITDA and working capital. So there are two areas, and I'll just hand over to Toby to talk to the final two areas that we've seen in our work.
Thanks, Ollie. Thanks, Shannon. Great. So carrying on in terms of the key diligence considerations for clients, another one of those from a capital markets perspective is the readiness of companies hoping to IPO. We've prepared an IPO readiness test, which is available through the BDO website, which is a tool through which answering a series of questions will give you an idea of the state of play or level of readiness of a company for an IPO. The tool also helps to identify opportunities to bring some of the work forwards. There's often a lot of pressure on management teams around an IPO, so anything that can be brought forward sort of eases that burden slightly. Our experience demonstrates also that sort of only the most prepared companies are able to sort of meet investor requirements and be able to proceed with IPOs. Across all sectors, we've including betting and gaming, we're also seeing a continued focus on financial position and prospects procedures in those capital markets transactions. This being another key reason to prepare appropriately for an IPO or capital markets transaction. Finally, looking forward to the coming year in 2022 and what we think we might see and hope to see in the sector. It includes continued high levels of US M&A activity, driven by the continued legalization of online gambling in more states. M&A opportunities may also arise from the breakup of big operators. As Ollie mentioned earlier, when Caesars bought the US assets of William Hill, that gave rise to an opportunity for someone else to acquire the non-US assets, and we may see more of that going into 2022. We're also expecting to see a continued focus on mobile products, boosted by the 5G rollout and consumer trends towards more wearable tech, and continued focus on new and fast growth products that the virtual and augmented reality, esports and social gaming products. The possible development and use of cryptocurrencies in the sector, for example, as a substitute for customer wallets, is something we could see in the coming years. And lastly, the sort of upgrading of land-based casinos to keep pace with that online shift. So that's it from Ollie and I. So thank you all for listening, and I'll now hand over to Dom Stammers to talk about the US experience.
Thanks, Toby. Thanks, Ollie. Very interesting session. Yeah, so just picking up on the US experience, I think by way of introduction, for those of you who don't know me, so I'm Dom Stammers. I'm an audit partner within our betting and gaming team based in London. As Kieran mentioned at the beginning, I've spent the last few years really focused on working with our clients who are looking to do something in the US. And really that's been, as Ollie mentioned, everything from either being acquired to going through an IPO route or looking to take part in a SPAC transaction. So it's certainly been an interesting last few years since sort of late 2019, really. And I think just picking up on the point that Kieran mentioned around our unique position at BDO, we're fortunate to be really the only firm that has a specialist team looking at betting and gaming. And in London, we also have a very experienced US capital markets team who support us on all of the US transactions that we go through, which again just sort of accentuates our unique position where we can help and support non-US clients and non-clients looking to do a transaction in the US. So a bit of a shameless plug there, but I've got to take the opportunity. I think our US capital markets team also work closely with me if non-audit clients are keen to do a transaction in the US, looking at things like gap conversions or accounting advisory work as well. Shannon, if you could just move on to the next slide, that'd be great. So just following on from the points that Toby and Ollie were mentioning there, clearly it has been a really busy time with non-US companies focused on the US. So I say that really because it is a unique position with non-US companies really taking advantage of what's been going on with the US opening up. And as mentioned, from my sort of starting position, I've been working with GAN and their listing, which started in 2019 and completed in 2020, moving through to Gamesys and their acquisition by Bally's in the US, which took place during 2021. And then also working with gambling.com and their listing in 2021 through to, as Ollie mentioned, the upcoming SPAC transaction with the Super Group, which is due to complete in the near future. If we could just move on to the next slide. Yeah, so I guess the key point for that is really from an IPO readiness perspective, as Ollie touched on, really there are some relatively useful observations that I just thought would be worthwhile just reflecting on, having been through quite a few of these transactions over the last few years. And I think, as you'd expect with looking at doing a transaction with the US or listing in the US, there's a significant amount of complexity and unknowns that the company and the finance team will come across, and therefore making sure that you have the right advice in place well in advance is key. And I think there are a few things around that, just looking at whether you have to have accounts under US GAAP or whether the current IFRS accounts that you have are still relevant is key. I think a lot of companies initially think that you have to transition to US GAAP, but if you are what would be called a foreign private issuer, so i.e. if you're not based in the US or have a significant shareholder base from the US, then you can still stick with your IFRS accounts, which can make the transition to a US listed company easier. But against that, you do have to go through a process of effectively re-auditing a number of historical periods, and those number of historical periods can vary depending on the rules. Under effectively what's called PCAOB GAS, so the US auditing rules. And with that, that brings typically a significantly reduced level of materiality that would have to be applied to your audit, and also specific required procedures, things like debtors confirmations, legal confirmations, all of those things that take time. And I think that just goes to really Ollie's point around IPO readiness. And if anybody's thinking about doing a transaction in the US, it's well worth thinking well ahead of that so that you can alleviate some of the pain rather than having to do a lot of these things retrospectively. And on the same vein, there is a kind of more heavy onus on controls and reporting deficiencies. So, for example, if you're going through a listing process and there are what management might determine to be material weaknesses in controls or processes, then there's a requirement to disclose those in your, effectively in the prospectus that you'll be submitting to the SEC. And again, just upfront thought around what might be material weaknesses and looking at addressing those upfront is time well spent. And I think the last couple of points that I would just come on to is really just flagging that, as well as if you're looking at listing in the US, as well as going through the listing process with the SEC and then doing your annual reporting in the US, there's typically more quarterly reporting requirements in the US, which effectively puts the finance team on a sort of non-stop treadmill of reporting, and therefore there's real sort of onus on making sure that you have the right level of financial support internally, and also that you've given the right amount of time to considerations of the bandwidth of the finance team to delivering on the reporting requirements that you'll see going forwards. So those are just a few reflections that I've pulled together just to run through in terms of thoughts of upfront thought around what you might want to think about if you're listing in the US. So if anybody is interested in talking to us about those things, then more than happy to have those conversations. I think that is it from me, and I'll pass across to Fiona to run through from an economic crime advisor.
Hi everyone. Thank you, and just on to the next slide, please. So firstly, to introduce ourselves, so I'm Fiona Roestrick. I'm one of our partners in our advisory practice, and I focus on economic crime advisory, so everything AML, ABC, many other acronyms related, fraud, etc. And we've got a wealth of experience in the gaming and gambling sector, along with the others on the panel today. And we're going to be looking at some of those priorities within the regulatory space and within the AML space this morning. Clorinda.
Thanks, Fiona. Hi all, my name is Clorinda Grundy. I'm a senior manager within the Economic Crime Advisory team, so I work closely with Fiona on a wealth of anti-money laundering, sanctions, bribery and corruption, etc. Opportunities and projects with clients. One of my main focus areas is betting and gaming, so that's why I'm here today.
Great. Next slide, please. Just quickly on what we're going to be covering in this brief session before the comfort break. So we're going to look at the sort of very forward-looking. I mean, we're obviously going to utilise the information we've identified over the previous year, but keep that in a forward-looking perspective to understand sort of what the key agenda points should be for firms in this sector from an AML perspective. We're going to look at some of the challenges on the horizon, but also some of the common themes arising from, for example, UKGC, etc., and what those trends might be like into 2022. Next slide, please. Clorinda.
Thanks, Fiona. Yeah, so the betting and gaming landscape is obviously continually evolving, and so the number and nature of challenges are also quite dynamic. But we wanted to take this opportunity to talk to two specific items that we've seen based on our work, and these include the increased popularity of the use of crypto assets and also the continued focus on money laundering by the UKGC. So taking that first category to begin with, back in November of last year, the UKGC reported that it's received a lot of interest actually from firms in the sector, specifically related to using crypto assets, so things like Bitcoin, things like Ether, to be used actually as a currency for funding gambling businesses or as a means to delivering gambling products. So for example, businesses might want to be funded by crypto assets through an initial coin offering. And UKGC noted that a real big issue in relation to this is actually evidencing the source of funds, especially when crypto assets are used. Something we wanted to point out was that the sort of stance by the UKGC is that it's very important to be able to determine that the source of funds is not the proceeds of crime and isn't derived through illicit activity. And therefore, the UKGC really urges firms to make sure that they can adequately justify the source of funds, even in instances where crypto assets are being involved, which could potentially be happening more and more often. And then from another angle, as well as business development and business funding, the growth of interest in crypto assets has meant that a lot of consumers are increasingly seeking to be able to use crypto assets to fund their play and their activity. We at BDO think that crypto assets are not going to disappear, and in fact, they're probably quite likely to continue and become more commonplace in society. So if this is the case, we strongly urge casino operators to consider how that's going to impact their businesses in terms of both treading with care and making sure the robust and deep due diligence is present. Moving then on to the sort of second point that we wanted to talk about, so the continued UKGC focus on money laundering prevention. A few months ago, again, the UKGC spoke about how they want to continue to tackle money laundering in the sector. And specifically, they called out that this is just as important as tackling harm and preventing harm within the sector. From their supervisory strategy standpoint, there's definitely been some challenges over the last couple of years, especially given COVID. Obviously, things have been needed to be done virtually, as we are today, rather than in-person site visits. And we know from this year's compliance and enforcement report published at the back end of last year that there's definitely a few areas for improvement, which we'll talk about shortly in the next couple of slides. However, just for now, the thing I wanted to make really clear was that the UKGC stance is that it will continue to take action where operators aren't meeting their duties, especially when it comes to prevention of money laundering and terrorist financing. And they really clearly know that this is the same approach, whether it's operators in challenges for the first time or from a repeat perspective. We definitely saw this into 2021 and then already in 2022 with fines continuing, and undoubtedly there's probably more to come. So I will hand back to Fiona to talk about some of those common sectoral challenges and questions that firms might want to be asking themselves.
Thanks. Next slide, please. So just on the next two slides, I wanted to go through, as Claudia mentioned, those common sectoral challenges, picking up on the UKGC's November 21 compliance and enforcement report. We've got 4 challenges that we're going to highlight. It's not exhaustive, but it's just picking out some of the areas where we've seen them in practice when we've been conducting independent reviews of firms in the sector on their AML and RD compliance, where we've been supporting firms in understanding what enhancements they might want to make to actually meet the regulatory expectations. These are some of the areas that we think are really critical to make sure you hit things in the right way. Challenge number 1 is around the use of outdated guidance and advice, or failing to use a full suite of information. So it's easy to say, well, there's obviously a really clear guidance from the UKGC, we can just apply that, but it's also making sure that you're looking across all aspects of guidance and advice, whether it's white papers, whether it's fines and the notices, etc., that come with that, whether it's articles, etc., and other things that have been written by UKGC and wider to really draw in the latest expectations of the regulator. Once you've been able to do that and you felt you've really encompassed all of the relevant guidance and advice that's out there, the question is, have you then trained staff to make sure that they're not just applying those procedures and policies as a tick box exercise, but they're really trained well to understand the business and understand, well, what does that actually mean for them? What are the patterns? What are the linkages? What are the fundamental risks associated with your client base, with your customer base in relation to AML? And are the staff really trained to spot that? So if something that's slightly unusual, slightly different appears, they're in a position to be able to understand what that question mark might be or what that potential risk or suspicion might look like. And equally, when you're considering around making sure that your framework is really open and up to date, what have you got in terms of those channels and dialogues with the UKGC? How have you maintained those? Who is maintaining those? Is it the right person? Is it the right level of communication? We're not suggesting you want to be badgering them to ask lots of questions all the time, because that's not their role in this approach. But it's making sure that you've got that open dialogue and that you can then draw on any comments and feedback that are provided, but also sharing information and help drive their agenda as well as vice versa. Challenge number 2 is the poor application of CDD measures and insufficient KYC checks. Now, what we've identified here is that firms will put in place an approach, a set of policies and procedures in relation to CDD and KYC processes. But what may not happen is that they don't necessarily step back from those. They become embedded, but also slightly tired potentially over time, and they don't necessarily get updated and reflected as they need to, picking up on that new guidance or those feedback that's come through from the UKGC. And so what we've seen quite a lot of clients doing, which has been great for us, we've really been able to feel like we've helped a lot of firms recently, is that, apologies, is that we've been able to conduct assurance exercises over the alignment of the practices in CDD and KYC and onboarding with those regulatory requirements to provide a real clarity using our wealth of experience, benchmarking with other firms, industry good practice, etc., to benchmark what that looks like then in terms of quality of your own KYC and CDD processes. So it's something that a lot of firms have started to do. A lot of firms should be doing to meet those UKGC expectations, but equally they're seeing a lot of value coming through it. The other thing in relation to CDD measures is actually thinking fundamentally about, well, if you've designed your CDD measures on the basis of an expectation about what my client base looks like and therefore what my appetite to risk looks like, have you actually made sure that you're aligning within that risk appetite? Are the processes that are being followed too blindly that means that you're not ending up applying that risk appetite? You're not stepping back and seeing that those tolerances that you put in place are actually being met. And lastly, within the CDD measures, a really important aspect is around whether the resources that you have, the team that you have, are actually thinking risk-based. They are actually applying that on a proportionate basis and on in a timely manner. And again, that they're not getting to the approach of just following a process because that's how it's documented, without really appreciating what that means in terms of fundamental risk. Because if they're not stepping back and being able to understand that, they then can't adapt to those flags and those challenges that may arise as a result of a new type of client or a new type of customer coming through the door. Next slide, please. Challenge 3 is in relation to identification of high-risk situations and obviously looking more from an EDD perspective. A couple of just main points here is making sure, again, when you're looking at your policies and procedures, also your training of your staff, that they understand what those high-risk indicators might look like, and therefore they know how to mitigate them and treat them. And what you don't want to do, again, is getting that really tick box approach, especially when it comes to the higher risk situations. They need to be able to do this on both an onboarding perspective and an ongoing monitoring perspective. So they really need to be understanding of the risks, the indicators, the flags that might trigger some of those higher risk aspects. And so it's, again, stepping back, considering what you've done in terms of training, what you've done in terms of validation of the understanding of your teams through monitoring, compliance monitoring, and QA checks, etc., and thinking how that might help in building out your team's capabilities when it comes to those higher risk situations. The other thing to also consider when you're considering higher risk and EDD is actually the thresholds that are set that result in something being triggered as high risk. Are they actually appropriate? Have they evolved over time? Hopefully you're reviewing those thresholds on a relatively regular basis, at least annually, but making sure that, well, actually, are they right? Are my customer risk assessment parameters, are they right? Am I getting the right split between high risk, medium or low, or whatever classifications you have used? Are my thresholds for monitoring higher risk activity appropriate? Has my business changed at all this year that may need to reflect that? And I think, again, a lot of firms can get stuck in a relatively static approach, and then they haven't actually reflected the more higher risk nature of their business at any one point in time. The last one quickly was just on the lack of clarity around the business-wide risk assessment and actually the use of it. Firms will put in place, hopefully, a comprehensive business-wide risk assessment in relation to AML and financial crime. And hopefully they'll have all the relevant components in there, and hopefully it will consider both the design of your controls and how effective those are. It will also consider quantification of risk rather than just the the narrative of the fact that risk exists. There's actually metrics and numbers and figures and data that we'll include in there to quantify risk. But then how is that actually used? How does that interplay into my framework, my controls, my policies, my procedures, my risk appetite, my risk assessment, and my customer risk assessment? And also, how does it apply into what senior management actually look at when they are monitoring quality of the due diligence, the monitoring, etc., with in the context of risk? This isn't exhaustive, as I mentioned at the start. It was just to make you hopefully think about some of those key areas that the UKGC continues to focus on and what we've seen in practice within our reviews. Corinda, over to you.
Thanks, Fiona. Thanks, Shannon. Preempted what I needed. Yeah, so just to conclude our section and also just spend a few minutes before we have a short comfort break, we just wanted to talk through a couple of sectoral trends, particularly things which we've observed through our work over the last sort of 6 to 12 months, which we thought it would be useful to sort of share and explore a little bit with this group of people. So the two that we want to touch upon particularly are affordability triggers and then the implications of the FATF grey listing of Malta, which took place in June of last year. So firstly, on that first point, so affordability triggers and it's especially a valid evidence for validation. I guess just to recap on the environment, we're conscious that a lot of the UKGC expectations and guidelines are crystal clear. However, there's others relating to AML and RG, which are a little bit more open to interpretation, especially ones which involve language such as may. And this is definitely the case in relation to affordability, where firms are asked to gain information about customer source of funds and legitimate levels of income in instances where it may be helpful to help them determine whether activity is in line with expectations and affordability. And it's really important to note actually on that point that therefore affordability has implications both in the anti-money laundering space, but also in responsible gambling and prevention of harm. And what we've seen from that sort of language and may and ambiguity is that there's quite a lot of diverse approaches employed within the sector to determine when it might be appropriate to collect additional information, to determine whether a player's play is in line with their affordability or not. So there's not really a particular common standard that we see happening time and time again. By and large, that's resulted in sort of case-by-case treatment, considering a variety of risk indicators and triggers. And whilst we've definitely observed this to be effective, we also remain cognizant that this can be cumbersome from an operational perspective. And this is something that the UKGC is also quite aware of too. So based on what we've seen, we would advise that it's critical for casino operators to proactively and continuously monitor their thresholds, their triggers, to keep adapting to the dynamic landscape. We're conscious that the UKGC recommends a precautionary approach, and therefore firms should consider investing in solutions which present the lowest level of disruption to business as usual operations. But also we're also conscious that guidance keeps getting updated, and there's been a few rumblings that specifically guidance related to affordability may change in the near-term future. And therefore we really urge firms to look into those solutions which limit business disruption, but can also be really easily adapted if possible to roll with those guidance changes. And then finally, the second topic we wanted to cover was the implication of the FATF grey listing of Malta, which I'm sure most of you are aware of and is a top priority in terms of control framework. As a very quick recap, in the middle of June last year, Malta was identified by the FATF as a jurisdiction under increased monitoring from an anti-money laundering, terrorist financing and proliferation financing perspective. And that means it's working closely with the FATF to address its deficiencies and hopefully shake that grey listing. However, in the interim, it means that Malta has joined nations such as the Cayman Islands, Panama, Pakistan, and thus the sort of grey listing has undoubtedly caused ripples in both the financial services and non-financial services spaces. So in terms of gambling and gaming, It's obviously no secret that a lot of operators, and particularly those with a B2C offering, are based in Malta and provide services both within the EU and also non-EU jurisdictions. In terms of the impact that that's having, something that we've definitely picked up on in a couple of our interactions with clients is in relation to Maltese operators. A lot of third parties connected to them, so banks, auditors, etc., have been looking to reevaluate their risk frameworks off the back of the Malta Grey listing. And they're requiring greater comfort from these Maltese casino operators with respect to their control environments. I guess in essence, the Maltese operators are now being subject to enhanced due diligence measures by their banks, auditors, etc. So what we've seen is that Maltese operators often require a robust and clearly independent internal audit function, and in some cases, external insurance has been really the only way to gain comfort about the design and effectiveness of their control frameworks. So to sort of conclude on that one, what we'd encourage is for Maltese operators in particular to consider how they can provide that level of comfort, specifically on the design, but also the operating effectiveness of their anti-financial crime controls. And then wider in the sector, we'd continue to encourage transparency and open communication between B2B and B2C operators, as well as operators in other institutions, to sort of foster that collaborative approach in terms of the global fight against financial crime. That's everything from our regulatory section. I believe we're now heading into a bit of a comfort break. I will let Kieran, etc., talk about that.
Everyone, welcome back and thanks for staying with us. My name's Daisy Borkflower. I'm a director in our corporate international tax team here in London, and along with Tim, who's the partner that leads our team and whom I think a lot of you already know, we'll be providing today's corporate tax update. And we're broadly looking to cover two main topics. Next slide, please, Shannon. The first topic is looking at tax matters relevant to M&A activity. As you'll have heard already from Toby and Ollie and most people that have spoken already, there's been huge M&A activity in the sector over the last year, and we expect that to continue into this year. So we thought it'd be helpful to share a summary of kind of key tax issues and trends we've seen come up on our transaction work and what we expect to continue to be relevant. The second topic, which Tim will be speaking to, is global tax reform and the OECD's proposals for a minimum global tax rate and what that can mean for businesses. And we'll then be passing on to our transfer pricing team so that they can pick up some specific TP developments as that continues to be a hot topic in tax. So turning to the first topic, and if we can go to the next slide, please. In terms of the M&A activity, how we get involved on the tax side is twofold. A big part of the work we do is on the due diligence side, helping with tax due diligence, either on the vendor side or the purchaser side, and we work very closely with the BDO corporate finance team on that. And then beyond the due diligence, the second kind of area where we get involved is on the tax structuring side for transactions. And a good number of our projects, structuring projects this year, have been around IPOs and transactions with SPACs, which we've also already heard a lot about already. So what we're looking to do is kind of share a summary of what have just been the key issues coming out of both of these work streams, and we'd recommend keeping them in mind for any transactions that may be on the horizon. So starting with the due diligence side, a real common area that we see as a risk is transfer pricing, specifically where businesses either don't have any transfer pricing documentation or they don't have appropriate transfer pricing documentation to support intercompany arrangements, and those being at arm's length and compliant with local transfer pricing requirements. Paul and Lizzie in their transfer pricing session will be picking up some specific pieces around documentation, but we really wanted to flag that it's something that does come up on due diligence. So if you're a business that's looking ahead to a sale or exit, we'd strongly recommend just reviewing transfer pricing arrangements and making sure robust documentation is in place, because it's definitely something that does come up. The second area that I think we see on most transactions is around what we call overseas establishment risk. And as a kind of a very brief summary, that can be where a business is registered for tax in one territory, but through having people, management, premises in another territory creates a taxable presence in that other territory. And that taxable presence can be a corporate tax presence as well as a presence for VAT. So the kind of the potential tax costs for that can be wide ranging. Obviously from a DD perspective, there's the issue of whether there are historic tax exposures, but we also wanted to mention, we see this type of issue also give rise to go forward issues for the purchaser, because if you're inheriting one of these types of establishment risk arrangements, it will lead to operational questions as to whether you continue with the current structure or you might need to make operational changes post-transaction in order to mitigate the risks. An emerging risk issue we see on due diligence, and have seen quite a lot over the last year, is where certain territories have introduced new tax legislation, particularly relating to online or digital businesses. So to give some examples, last year, Canada, which is a territory where we've seen lots of activity in this sector, introduced new digital services tax rules. Last year, India, another emerging market, expanded the scope of its equalisation levy, which applies withholding taxes to revenues from Indian customers. And these are all types of tax rules that can apply to non-resident entities. And the particular issue we see is that it's not always clear how these taxes might apply to online businesses in this sector. So when it comes up on DD, it's quite a tricky issue to navigate, because there's not always clear guidance from tax authorities, because these tax rules are new and there's not always existing case law. So I think if looking ahead to diligence scenarios, we'd be recommending taking specific local advice on these taxes, because it will likely be a trickier issue that comes up on review at the time of a transaction. And then finally, these aren't necessarily corporate tax points, but they are common tax issues we see on the employment tax side, notably where businesses use contractors and there's non-payroll tax risks, and also arrangements involving employee share plans or management share incentives. We're seeing those give rise to some material tax costs. And again, if you're a business that's looking ahead to a potential transaction, we'd recommend reviewing any arrangements that fall within those categories, because there could be hidden tax risks included in those. That's not necessarily an exhaustive list of tax risks we see from our due diligence work, but hopefully gives a flavour of some of the more material issues. We also want to pick up on some of the common trends and issues from our work for IPO transactions or transactions with SPACs. And again, this isn't an exhaustive list, but hopefully gives a helpful overview for anyone that's looking ahead to these types of transactions. The first issue we wanted to mention is around pre-IPO readiness, which I know is something we've heard quite a bit about on this call already. On the tax side, we see that take different forms. It can include businesses looking to tidy up any known tax risks before a listing, and those risks might be transfer pricing or some of the ones I've just mentioned around overseas establishment or use of contractors. And the second aspect is often to form the perimeter for a listed group. There may be a carve-out transaction or different assets transferring in and out of the structure to form what will be that perimeter of a listed group. And when we have those types of transactions, there are often tax implications to consider. Another kind of hot topic is working out what might be the suitable location for the listed vehicle, not just in terms of incorporation, but also tax residence. With SPACs, there's often some preference on the SPAC or investor side to use certain jurisdictions such as Cayman or other low tax jurisdictions, and there's typically a thinking piece as to whether a company might be incorporated in one of those territories but treated as tax resident elsewhere based on where management are or will be located. Some practical considerations that we see with transactions where a company may actually merge with a SPAC typically relate to the positions for the shareholders. If UK shareholders are involved in this type of transaction, we'd typically be recommending advanced tax clearances of sort to confirm the tax-free treatment of that transaction. And with the advanced tax clearances, it's worth keeping in mind that HMRC should take up to 4 weeks to respond, but we are seeing in practice that they take longer, and that's something worth factoring into any timetable ahead of a transaction. Also, there can be issues where a SPAC has existing warrants in place, and those are being part of any share exchange transactions, and also the position for any existing employee share options. Sometimes these types of issues, we're seeing them get picked up fairly late on in a transaction process, and they do carry complexity. So they are certainly things to think about sooner rather than later for these types of deals. And then another piece that I wanted to mention was the US PFIC rules. PFIC stands for, it's all to do with where a US investor is investing in a non-US company, and that non-US company is a passive foreign investment company. And how these rules apply is if you're a listed non-US group with US investors, there's a risk that the income and profits of the group can be attributed up and taxable at the level of the US investor. And the downside of that is it can impact the marketability of shares for US investors if they think it's going to carry additional tax costs for them. What triggers the rules is if a group has this passive foreign income above a certain threshold, and it's something that needs to be monitored on an annual basis. But we're recommending groups kind of do provisional PFIC testing up front in order to assess the potential impact of that. Because if there are going to be issues under the PFIC rules, there are certain protective elections that can be made, and obviously they need to be worked through in advance of any listing. And then just as a final point, once listed, similar to I think what Dom was saying about additional controls and reporting requirements if you're a listed group, that extends to tax, and there can be additional tax governance and tax control obligations for listed groups, and it's worth something to think about upfront to make sure that any in-house finance or tax function is well prepared for that and understands the obligations that it will be quickly facing once listed. I'm conscious that's quite a whirlwind tour through all of these topics, but of course, separate to this session, we're more than happy to talk through any of these points if you're looking ahead to these types of transactions. And with that, I'll pass on to Tim.
Thank you, Daisy. If we could have the next slide, please, Shannon. So I'm sure many of you will be aware that the OECD has been undertaking further work in its seemingly endless quest to reform international taxation for multinationals. There are two separate strands to the current work aimed at making multinationals essentially pay more tax in more places. First is known as Pillar 1, and this involves the partial reallocation of taxing rights over the profits of the largest and most profitable multinationals to jurisdictions where their customers are located. So that strand is really about where the profits are taxed. But it's only applicable to multinationals with global turnover in excess of 20 billion euros and profitability of over 10%. I'm not going to say anything more about that today because I want to turn now to Pillar 2, which is likely to be more widely applicable and where there have been some more recent developments. So in December, the OECD set out its detailed proposals for the operation of Pillar 2. It's known as a GLOBE, which sort of stands for Global Anti-Base Erosion Rules. And this really is much more about the amount of tax that multinationals pay. And it proposes a global 15% minimum tax rate that will apply to in-scope groups with global turnover in excess of 750 million euros. Now that the detailed model has been published, then the next steps pass to each government for implementation in domestic law. And there are over 130 countries that have committed to doing this, so it's quite some scale. And the intention is the legislation is going to be enacted in 2022 to become effective from 2023. Now that sounds like a hugely ambitious timetable, but then many people didn't think that the project would have progressed as fast and as far as it in fact has to date. So don't bet against it. Shannon, can we have the next slide, please? So we can just talk a little bit now about how Pillar 2 should be expected to work. And in order to make this minimum 15% tax rate effective, there are essentially two main mechanisms. The first is that there's going to be a top-up tax, which will be applied in the parent entity jurisdiction of a group which has low-taxed subsidiaries in different countries. So just to kind of clarify that, let's think of an example. So if we have a UK parent company that has a subsidiary in the Isle of Man, the UK tax rate is currently 19%, soon to go up to 25%. But the tax rate in the Isle of Man is 0% for most companies. Under these Pillar 2 rules, the UK company will be obliged to pay tax not only on its own UK profits, but also to pay 15% tax to HMRC in respect of the profits of that Isle of Man company as well. This is called the Income Inclusion Rule, or the IIR for short. Obviously, those of you whose fancy turns to tax planning might be thinking, well, we could easily get around that by making sure we have a parent company in a low tax jurisdiction that doesn't apply these rules. Unfortunately, the OECD's thought of that, and there will be a secondary rule for such cases called the undertax payment rule. So where there's a low taxed jurisdiction and the shortfall in tax between the tax rate applicable there and the 15% isn't picked up through an IIR, then the UTPR will work by allocating the shortfall in tax to affiliates of that low taxed entity in other countries using an allocation key that's based on tangible assets and employees in each territory. So obviously, to determine whether we meet the 15% minimum tax rate, we're going to need a common set of computational rules that we can apply. And the way it's going to be done is by using the financial accounting profit for each entity under the gap that applies to the parent company's consolidated financial statements in most cases. However, this profit will then be subject to adjustment for certain items, including transfer pricing, intragroup dividends, gains from the disposal of substantial shareholdings, and so on. And there are also going to be rules dealing with things like losses. So that will be how you get to the globe income or loss for these purposes. And then in terms of calculating the taxes, we're talking about corporate income taxes, so taxes like corporation tax, not sales taxes or VAT or anything like that. But you're not just going to be looking at cash tax paid in a period, you're also going to be required to take into account deferred tax liabilities and assets. So where a group has multiple entities in a given territory, you're going to need to work out an effective tax rate for the group in that whole country by reference to the aggregate profits and losses and taxes of those entities. So it's starting to get quite complex. And just to pick out a few more points of interest, there was some uncertainty over how the rules would affect some countries like Estonia, where there's no corporate tax on profits until they get distributed. So we're going to have some detailed rules that will address those situations, and broadly speaking, they'll prevent a tax charge from arising where the profits are distributed within a 5-year period. There was also a question mark over special tax regimes such as R&D tax relief and whether those benefits would effectively be reduced or eliminated by the Pillar 2 rules. Now, as far as the UK is concerned, HMRC say that the RDEC will be treated as income of the company in receipt of it, rather than being treated as a reduction of the tax paid. So this should mean that it continues to be a worthwhile incentive. In terms of administration, the expectation is that each group will file a single GLOBE return, normally in the parent jurisdiction, and the tax authority there is then going to have to share that out across all the other relevant jurisdictions to ensure that the correct amount of tax will ultimately be borne by the multinational group. It follows from that, I think, that the groups within scope can expect to have a really substantial additional compliance obligation. So turning now to some responses from particular countries, we noted, I think, that in Gibraltar, we've already seen an increase in their domestic corporate tax rate from 10% to 12.5%. And I think they've announced that they expect to increase it further to 15% in due course. And I believe that there's no de minimis there, so that's going to apply regardless of the level of turnover of the company. By contrast, though, Malta is another low tax country. Most companies there will pay an effective rate of about 5%. Malta said that it intends to, I believe it said that it intends to increase its tax rate to 15%, but only for companies with worldwide turnover in excess of 750 million euros. And I think they thought, it was reported there are about 20 groups that would be affected in Malta. The EU has already issued a draft directive for implementation of the GLOBE rules within the European Union. But one of the biggest open questions, I think, is how it's going to be implemented in the US. I think many of you will be aware that it's extremely difficult to implement tax reform in the US, particularly at the moment as the Democrats have control of the administration, but insufficient control at Senate level to force through significant tax changes. It's worth noting, though, that the US already has GILTI rules, which are sort of similar in concept, if very different in the detail. And there's likely to be some ongoing OECD work aimed at reconciling the GILTI rules with the GLOBE proposals once we have more clarity on exactly what can be achieved through the US legislative process. It's notable, though, that the GILTI rules don't have a de minimis, and we're waiting to see whether other countries choose to implement GLOBE without that. So I'd suggest that even if your group is below that 750 million turnover threshold, you should still keep a close eye on where this is going in each country that you're in case countries unilaterally extend the rules to smaller companies, which they are entitled to do. Here in the UK, the government this week issued a consultation document seeking inputs on its proposals for introducing these rules in our domestic legislation. Unfortunately, this was after we'd already written our slides, so it's not on the slides, but we've read through it, and the government has committed to conforming as closely as possible to the model rules, and has said that it expects to implement the income inclusion rule from April 2023. With the UTPR rule potentially following the next year. And it is also confirmed that it only intends to apply these GLOBE rules to large companies over 750 million euros. One of the more eye-catching proposals in the consultation document was for a domestic minimum tax, but again, only for the larger companies. It wasn't quite so clear that this would be 15% in line with the GLOBE rules, or whether it could potentially be a higher number. But I think the government's thinking about this is that if anyone's going to collect any extra tax on profits arising in the UK, it may as well be them rather than a foreign parent company somewhere else. Finally, I guess I should note that these rules will apply alongside rather than replacing our existing CFC rules or indeed any of the other panoply of anti-avoidance rules we have, like the diverted profits tax, anti-hybrids, etc. Shannon, can we have the next slide, please? So in conclusion, I'd suggest that we should all keep monitoring the ongoing developments, both in terms of the OECD commentary that's going to be published soon, and in terms of the progress of local legislation in the UK and indeed elsewhere. If you are a large company and you know that you're going to be caught by this, then I think you're going to want to understand the detailed computational rules and assess the impact on your tax rate. But probably, at least as importantly, you need to start thinking now about how your systems and your processes are going to deliver the compliance requirements. And in that regard, I'd emphasize that the globe profit that you need to calculate for all of this is going to be a different number to any other kind of measure of profit you currently calculate for accounting, reporting or tax purposes. And I've skated over a huge amount of detail in the interest of time. So there's the limited substance carve-out rule, there are transitional rules, both for the implementation of the reporting and also for companies that become large. We haven't had time to cover any of that today, but I'd be more than happy to follow up with any of you who are interested in discussing it further. But that's a whistle-stop tour of the Pillar 2 rules. You'll be hearing a lot more about it, but for now, I'll conclude there and hand over to my transfer pricing colleagues, Paul and Lizzie, who are going to give us an update on their recent experiences.
Fantastic. Thank you very much, Tim. Hello, everyone. Good morning. So we're going to spend 5 or 10 minutes now just taking you through some updates for transfer pricing. My name is Paul Daly. I'm a partner here leading the UK transfer pricing team. I sit on the global leadership for transfer pricing, and I have a particular focus on the betting and gaming sector. And I'm joined today by Lizzie. Lizzie, if you want to intro yourself briefly.
Hi, I'm Lizzie Preston. I'm a senior manager in the transfer pricing team, specialising in betting and gaming. So I'm helping out with the presentation this morning.
Fantastic, thank you. So as you heard from Daisy and Tim, the focus on international tax is very much continuing. And with regards to transfer pricing, we're seeing a general ratcheting up of compliance obligations across the board. The OECD have done a lot of work on the transfer pricing framework over the last several years now. And what that is turning into is heavy emphasis on local implementation within domestic regimes. So we're seeing some common themes within that as tax authorities really start implementing the transfer pricing rules that the OECD have created for everyone. And one theme running through that is a critical focus on compliance and how it is that the transfer pricing position is being evidenced through analysis and documentation. So we maintain in BDO a global database of compliance obligations for transfer pricing, and it's clear to see from that there is an ever increasing level of mandatory documentation requirements in territory or tax return filings that attest to the existence of documentation or disclosure schedules that go with tax returns that set out the nature of intercompany transactions and whether there's documentation supporting that. And that's very much designed to really turn up the heat on the compliance and to encourage the right behaviour from taxpayers in terms of the way that transfer pricing positions are arrived at and supported. So we're seeing that turn into enhancements perhaps in territories. We're seeing new rules being introduced, and there's examples in point. So Malta has just announced a consultation for Christmas on the introduction of transfer pricing documentation and document rules with potential effect from 1 January 2024. There's a consultation currently open that closes at the end of Feb. And the UK, which we'll talk more about shortly, is also developing their practices, both in terms of the legislation but also the practice itself that we're seeing from HMRC in terms of interaction with taxpayers in inquiries and the PDCF. So if we could go to the next slide, please. We're going to start with PDCF and inquiries. And so those of you with keen memories who attended last year will recall that I spoke about the PDCF then. So why am I speaking about it again this year? Well, really two reasons. So one, we know that HMRC are focused on the sector, and there are and have been a number of PDCFs for businesses within the sector. And secondly, we're also seeing the experience that HMRC are developing through the PDCF programme feeding into the approach to inquiries, but also we can see the influence of that on the updating of the rules and the potential new legislation, which Lizzie will talk about in a couple of minutes. So we haven't got time this morning to take you all the way through the profit diversion compliance facility details. So I'll just leave it as it's a voluntary disclosure facility, which really is aimed at those types of arrangements that might be in point for diverted profits tax. What it has been evolving into is really a way for HMRC and businesses to interact around transfer pricing and the rebasing where necessary of transfer pricing arrangements. It operates really through HMRC initial risk assessment, which then turns into nudge letters, which suggest that a business might want to think about whether their transfer pricing is correct, or otherwise they might wish to avail themselves of the profit diversion compliance facility. There is then a well-established process in terms of registration, so really the setting of the scope between the business and HMRC as to what areas will be looked at, and then there is a prescribed report with necessary content and analysis, which is produced by the business and their advisors to then submit to HMRC for agreement. And there's a very important distinction between PDCF and inquiry, and it's very much around the control of that investigation and developing the evidence. The PDCF gives that control to the taxpayer, and that makes a very big difference in the conduct of that, because it's resource intensive, but where you work through the PDCF, there's a lot more control given to the taxpayer, which means that there can be a more ordered and perhaps more structured way of establishing the position and the evidence. In an inquiry, it's often an ongoing response to HMRC questions, and I'm sure some of you on this call today will have had experience of inquiries. They can be long-lasting, and there will be a sequence of very detailed information gathering questions that can lead to more questions in response to that, and that is a process that can sometimes take years. A PDCF process is compressed and is aimed to be completed within months, although we are seeing HMRC flexing some of that timing given the level of activity they're currently dealing with. So some of the themes that we've seen emerging from the PDCF over the last year, the PDCF cases we've been involved with, we know that the betting and gaming sector is one of focus, and the HMRC, as they work through PDCF and inquiries, are building up their collective knowledge and precedent, i.e. they're agreeing positions with taxpayers that then feeds into their thinking and that we can see emerging in other PDCFs or inquiries. The PDCF is very evidence-based, and that evidence-based view is feeding into how it is inquiries are being conducted. And I'm certainly seeing, in some cases, certainly far more emphasis on the evidence. It's fine to be able to articulate the theory and the policy, but we're finding HMRC are more and more focused on finding the evidence then that supports those particular assertions. We're also seeing profit splits being a useful tool, both in PDCF and inquiry cases, either as the methodology itself, i.e. how it is that you establish the transfer price, or as a way to corroborate the existing transfer price. And I think it's very helpful in the in the sector, given the often quite integrated nature of the operations, but it also doesn't leave anything outside of the analysis. A profit split can give you a view as to how all of the pieces fit together, and that can be a particular comfort to HMRC and also businesses in ensuring they've got an appropriate supportable position. We're also seeing the timing flex, as I alluded to earlier on PDCFs. The PDCF is ostensibly quite regimented in terms of the timing. The practice is that there's a lot on for HMRC and that PDCF can be quite time consuming. So that timing is flexing. That can call into question though HMRC's desire and ability to protect its position by issuing certain discovery assessments, which essentially keeps a year open for review. Those discovery assessments are usually, from HMRC's perspective, very prudent and can have quite large numbers attached to them in terms of potential adjustments, which can cause focus internally for businesses and need to be rationalised and decisions made around provisioning and so on. So lots going on with the PDCF of itself and the feed into inquiries, but we're also seeing it feed into the general approach to transfer pricing compliance in the UK. So perhaps we could go to the next slide and Lizzie can talk to us a little bit about what we're seeing coming down the line from HMRC and changes in the law.
Thank you very much, Paul. So yeah, in line with this sort of increased focus on transfer pricing compliance, and also probably to bring it bring UK in line with other territories, HMRC issued a consultation in March 2021 on the introduction of specific transfer pricing documentation. The key areas of this consultation were sort of a master file and local file, an evidence log, and an international dealing schedule. The result of this consultation was released at the end of November, and the government intends to release draft legislation in 2022 with the aim to make it effective from April 2023. They have also noted they'll plan to provide further practical guidance alongside the legislation. So the key takeaways from this consultation is the introduction of a master file and local file. So this will focus on group and UK operations. This will be for businesses, it should be 750 million euro turnover rather than the 750 euros turnover. So this will be in line with the CBCR thresholds. But I think what's probably important to note is that in the consultation response, HMRC noted that this will now be considered best practice for transfer pricing documentation, and therefore encourages all businesses which need to apply transfer pricing to take this approach. And as Daisy noted earlier, transfer pricing is something we commonly see come up in tax DDs. So we would expect external parties to also be expecting documentation in this format. We're expecting it to be closely aligned to the OECD standard, which many of you will probably be familiar with from requirements in other territories, and most groups of this size will probably already have master files in place. And it should be prepared ahead of the annual filing, and HMRC can request it and expect it to be submitted within 30 days. So the new thing, which is quite different from what you might have seen elsewhere, is the introduction of a summary audit trail. So in the initial consultation, there was reference to an evidence log, but there were a number of concerns raised about this, principally that it would be too onerous to maintain, and there's also a subjective nature to what evidence is. So HMRC have said they're not going to introduce this evidence log, but instead they'll have a summary audit trail. We don't know a lot about what this will include, but HMRC have said it will be a short document which summarises the work undertaken in arriving at the conclusions in the transfer pricing documentation. So the aim is to encourage taxpayers to undertake sort of sufficient work in supporting their TP policies. So there will be further guidance on this, but we would expect it to focus on the sort of representation of the facts in the documentation, the implementation of transactions, making sure sort of economic analysis is kept up to date and applied appropriately. And in good news, HMRC have decided not to introduce an international dealings schedule, mainly because most of the responses to the consultation noted this would be really difficult to prepare. It would take significant time and investment. although HMRC have noted they'll keep it under review and potentially implement it going forward. Next slide, please, Shannon. So this is similar to a slide we've presented previously, and sort of sets out on the right-hand side in the grey bars the transfer pricing yield over previous years, and in the sort of table below the DPT yield. We haven't yet got the figures from HMRC for 2021, although we're expecting them imminently. And the key thing to note from this is the sort of largely inverse relationship between the DPT and TP yields. And this is mainly due to an increased focus by HMRC on the use of facilities such as the PDCF, and the sort of increased focus on transfer pricing over DPT. Cool. Hand back to Paul now.
Great, thank you, Lizzie. So just to wrap up, Shannon, can we go to the last slide, please? So some points to consider. I'll really draw out the point around the maintaining documentation, including contemporaneous and supporting evidence. The influence on the PDCF on the upcoming changes to the UK legislation, as Lizzie outlined, was really around the evidence log that has then turned into the summary audit trail. We are going to see more and more emphasis, I think, on not just the outcome of the analysis, but how it is that a business is confident that they've got the right facts and supporting evidence to underpin that. So I would recommend that, yeah, a real focus on, as that analysis is put into place, there's also a lot of thought given to, well, what documents could we maintain, retain to evidence the position as well. Okay, well, thank you very much, everyone. I think I'm now handing over to our colleagues in indirect tax, Martin and Chris.
Great, thank you, Paul. Next slide, please, Shannon. So morning, everybody. For those that don't know me, Martin Haynes, I'm a partner in the team focusing on indirect taxes, and I'm joined today by colleague Chris Evans, who's an associate director in the team. Next slide, please. So as we normally do, we thought we'd start off with a summary of picking out a few key points that we think are going to be interesting for those that are interested in indirect taxes in the coming year. First thing to note, sort of back end of last year, we saw a significant increase in HMRC activity in the sector, particularly focused on duties. We'll touch on this in a bit more detail in a couple of slides' time. At the start of April, we have the temporary reduced rate for leisure and hospitality, ending and reverting back to the standard rate of 20% before you really had an opportunity to enjoy the benefit of the reduced rate. Rank claims, we're aware of some significant claims already being settled and paid, but I think it's fair to say there are a number of other claims outstanding with HMRC that have stalled, and the responsiveness of HMRC isn't consistent with what we're seeing. As I mentioned, their increased activity where they think that operators might owe HMRC money. There's a couple of interesting developments around the place of supply at European level for VAT of electronic services, which Chris will touch on in a bit more detail on the next slides. And we think our old friend use and enjoyment will become more relevant this year, both as a result of Brexit and as European tax authorities get to grips with decisions such as the SK Telecom case. Again, at European level, we expect to see more member states react to the VAT grouping case involving cross-border transactions and VAT groups in Danske Bank. At the end of 2021, we had a working paper at European level discussing some of these issues, and we recently had tax authorities like the French tax authority sort of share their hand, how they think the case might impact their rules. Of course, to most businesses in this sector, the real member state that we're really interested in seeing how they react, if at all, would be Malta. I felt a bit left out of all the other presenters talking about M&As and activity and transactions. So this case is interesting in its own right from a technical perspective, but also impacts transaction costs, hotel tour case. So it's an often litigated area, very much a hot topic for VAT and the recovery of transaction costs. It's a first tier tribunal decision published at the end of December. So at this stage, it's not binding on other parties, but we think it's a case to follow and to be aware of. It's about the VAT recovery on professional fees from the sale of one company as VAT grouped with a trading company that operated a hotel. There were quite a few key issues that the tribunal had to decide on, but for me, the key issue is whether the services provided and the professional fees could be directly and immediately linked to hoteliers' exempt supply of the shares, or they could be linked to its downstream taxable activities. Normally, when considering the impact of share sales, existing share sales versus the issue of new shares, the long-standing cases of BLP and Midland Bank are often cited by HMRC to deny VAT recovery. But the tribunal in this case considered these but made no comment, seemingly placing increased authority on Franco Smart and for a Supreme Court decision and the European case of ABSKF. The tribunal thought that objectively ascertained the purpose of the share sale in this case was to fund hoteliers' taxable downstream business activity. It thought the effect of the authorities that it cited is that the relevant objective is of the fundraising and not the immediate share sale is the relevant use of the funds. It felt that the use of the professional services in the initial fundraising transaction didn't break the chain unless, and it put a big caveat in its decision, the cost of the professional fees could be shown to be a cost input of the price of the shares. Whether HMRC publicly show any reaction to this case or not will be interesting. They could well just ignore it as a first-tier tribunal case, or they could appeal. But I think before any businesses can rely on this, I'd expect there to be more litigation in this area. And finally, on our watch list, there's a couple of European cases involving vouchers, one of which is the GE Aircraft Engine Services, actually a UK case. One of the last cases referred to the CJU pre-Brexit. These cases will be relevant for employee perks and rewards and incentive schemes, but we think it could have a wider impact and be of interest to any operators, particularly land-based operators, offering membership and reward incentive schemes. In the GE case, there's a AG opinion due out at the end of this month. It's not the full decision of the court, but the AG opinion normally has a lot of detailed technical reasoning that can give some insights of to how properly to interpret the relevant law. Very interesting for us indirect tax practitioners, but for those of you that aren't so interested in long, detailed technical analysis, we're obviously be in a position to share highlights and summaries of any key action points and risks and opportunities that come out of these cases. Next slide, please, Shannon. So for anybody with an interest in the two voucher cases I've mentioned, this slide just sets down the key issues and questions that the court will be looking at in each case. In the interest of time, I don't propose to go through these, but these slides are shared with after the presentation. And next slide, please, Shannon. Over to Chris briefly.
Yes, hello. Yes, I mean, we say this sort of every year that on online digital taxes, more and more jurisdictions bring them in. Daisy mentioned Canada in particular, who brought it in July last year, and Argentina another one, as well as quite a few countries in Southeast Asia, Indonesia, Malaysia, Vietnam, have done similar sorts of things. And it's the same issues that you kind of see everywhere, which is these are quite broadly written. Tax authorities aren't entirely sure about how to really handle compliance for people who are outside the territories. And in particular, gambling is not all that easy to tax under most VAT systems and sales tax systems. So it can result in weird oddities arising. One potentially a bit more locally interesting is an EU decision ECOFIN, so the European Council of Finance Ministers, created a decision at the end of last year, December 2021, that amongst other things will change the place of supply for virtual services and streaming services, clarifying, if you like, that where entertainment services are provided by streaming or virtually, that the place of supply is the location of the customer. Really, what that's almost doing is removing some of the interpretation and grey areas around what is and isn't an ESS, on the basis that a lot of countries and a lot of companies take different views of how much minimum intervention is actually going on within their operations. And so some countries will mean that means you do have a local VAT charge arising, and some doesn't. And if this is implemented, it would mean that that sort of distinction is sort of erased, and actually pretty much everything you do entertainment-wise virtually, which gambling would very much fall within, I expect, would be taxable where the local customer is based, sort of removing some of that uncertainty around the application of the ESS rules. In terms of process and sort of a slight diversion into EU process, which I'm sure we all enjoy post-Brexit. At the moment, it's within the council. So all 27 countries have sort of put forward draft legislation, and it will need to be voted on by the council. So all 27 countries need to agree. The heads of state would need to have a vote. It needs to be unanimous. So even one person saying no would mean this pauses or halts entirely. But frankly, it's a part of a package that also involves a load more freedom for EU countries to set their own VAT rates, especially reduced VAT rates. So our expectation and the likelihood is that this will be passed relatively quickly and then transposed into local law relatively quickly after that. So looking possibly within the next year to 18 months, this would come in and be enforced. Next slide, please, Shannon.
Thanks, Chris and Shannon. So as we said at the start, we're seeing increased activity towards the back end of 2021, which we think will increase this year from HMRC. We're aware of a number of larger groups that are part of the business risk review process have already been told that to expect more review work to be carried out as part of this year's process. But we're also seeing increased level of interest from HMRC into compliance into gambling duty profiles for operators of all sizes. From what we can see, the triggers for HMRC's interest seem to be, first of all, if you've got any interaction with HMRC, so for example, you've made a claim or maybe missed a payment or later making a payment, filing a return, that sort of interaction does lead to additional questions from HMRC. But we're also seeing operators being contacted with relatively standard set of questions, but with a particular focus on remote gaming duty, but not exclusively related to RGD. So that would indicate more of a targeted campaign from HMRC. Couple of common themes coming out of HMRC's line of questioning. So our old friend GGR versus taxing the first use of bonuses, which the legislation requires. Quite a big focus on player location and evidence of player location. A big focus on free plays and the valuation attributable. And also a couple of requests for IT and software related audits and reconciling RGD or gaming duty data to systems reports and tracking the life of a bet through the bet ecosystem. One other thing we've noticed from our work, which I think is very important to note, is HMRC are going through terms and conditions and promotional material shared with players and publicly available with a fine-tooth comb, and often, as is always the case with tax authorities, picking the terms and conditions that suit their argument and perhaps not giving full attention to others, which might suggest that HMRC's position may not be correct, but please be aware of it. Anything you put out in the public domain will be looked at by HMRC. I think in the interest of time, we'll hand over to the next team.
Thank you, Martin. Good morning, all. I'm Fiona Davis. Delighted to be speaking with you today with my fellow partner, Jason Gottschalk, who you will hear from shortly. So we both sit in our digital risk advisory services team, and I lead our third-party assurance services, which is helping our clients navigate this agenda. So what is this particular session all about? Well, in a nutshell, it's how we help our clients respond to a wide range of different triggers or situations through informing them of a range of assurance reports or standards available, such as SOC reports, SOC, which is on the heading here, not to be confused with SOX, and really helping them navigate the associated options and how best they can proceed. So today's a bit of a canter through this, whilst we draw upon quite a few of the points already raised today, framed in perhaps just a slightly different way. So if we can just, Shannon, move to the next slide. Thank you. So firstly, let's think about the increased complexity of the risk agenda. There are key areas for the sector where there have been increasing demands for transparency as a result of some element of breakdown in trust And in its simplest form here, trust cannot be gained as a result of saying you do something. You now need to demonstrate this to really ultimately provide that confidence to the increasing number of stakeholders. So you will have all no doubt captured some of these risks somewhere in your risk registers. So perhaps if I maybe start here with the critical service provider dependencies, this is really one of the most prevalent areas where there is demand for assurance reports and assistance, and a few scenarios probably to flag around these. You all no doubt outsource something, be it your data center or typically some area of IT, and you may indeed be a third party yourself in the model. So within this scenario, it's not simply enough to say risks have been outsourced, so it's not your responsibility. You will be asked for, indeed you will need to ask for, an independent assurance report really to provide this visibility to this regarding the service provided and the operating effectiveness. So this should be undertaken from a good practice perspective, but it really also plays heavily in the scenarios previously mentioned by the team, such as DOM for an IPO, a US listing, perhaps triggering a SOX requirement. Secondly, the industry is an increasingly complex network of interdependencies where you may as a business be partnering with others, such as partnering with gaming solutions to enable digital growth. And as part of these contractual requirements, we're seeing requests for SOC reporting, Service Organization Controls, SOC, really embedded as standard within this. And Jason's going to shine a light in this particular example afterwards. So having such reports therefore becomes very much a license to operate in the markets. You have to do these to be able to engage. Looking on regulations being mentioned a lot today, moving on to that. Assurance demands really embedded within this. Kieran very kindly set out the scene at the beginning in his intro, outlining how the audit regulators even side of things where independent assurance reports are increasingly being asked around areas such as revenue, maybe a surprise to some, security, resilience. We're seeing HMRC waking up to the benefit of this and seeing reports as a key mechanism for them to gain comfort. But what more of you may be more familiar with is the Gambling Commission and the range of requests that have come from them, including security audits and remote gambling to wider social responsibility aspects, really demonstrating, helping to demonstrate how you're doing the right thing, being at the heart of this. The team also earlier raised the point of the unprecedented amount of data at your fingertips, and this evidently causes significant concerns to stakeholders really as a result of the key risk that this presents. So the security around this, the resilience of the business, therefore subject to significant scrutiny and demand for assurances that this is being managed in the right way. So independent assurance reports therefore becoming the norm as a medium of alleviating concern by really demonstrating a control environment in place to address these areas. Key one to pick up here then is around performance reporting. ESG agenda very much on the top of all boards' agendas and increasing expectations, not just to disclose some of those points raised earlier, but to have this independently validated. We've all heard the term greenwashing, the confidence required on this, and the information reported. And David Perry previously outlined the TCFD reporting requirements that have come into play. And this builds upon greenhouse gas emissions, streamlined energy carbon reporting, a whole raft of areas. But the point here is there are a range of ways to support you reporting confidently around this through the independent assurance to remove that suggestion of greenwashing in this respect as well. Just one final point to pick up here on promises that you may make to your customers as a result of your product or service. Any misreporting in this can really lead to significant reputational damage. So getting some element of independent assurance on such promises can really help support that credibility and indeed assist if any damage limitation if any issues occur, as this can be shared more widely. So just moving on to the next one, Shannon. So I've mentioned independent assurance a few times here so far. You may say, I've got a great internal audit function, or I've got some great controls in place, so I'm not worried about this. This is not relevant. Well, this is a great start, but it doesn't quite go far enough. So just a few words on this. Firstly, robust controls should really be at the heart and in place for you as a business from a hygiene perspective across your first and second line of defence, hopefully terms you're all familiar with. But many more are waking up to internal audit as well as a key mechanism for providing assurance to the board of what's in place. And whilst that is definitely independent assurance, it is very much to internal stakeholders and really addressing their needs. But based on some of the triggers that I've flagged to you in those scenarios in the beginning, demand very much growing for further assurance to be provided externally to a broader range of stakeholders, those regulators, investors, the market, etc. So let's just look at what those assurance options could be and what to look out for. Shannon, can you maybe just move to the next one? So, nature of assurance is going to be required or asked for, very much subject to the nature of the subject matter that requires this assurance and the level of confidence required around this. And here you'll see a range of different standards that you may or may not have heard of before. And apologies, we've inundated you all today with a whole range of acronyms. But just a few examples within this. Firstly, should confidence be required from your financial auditor, which you mentioned at the beginning, or indeed from your client's financial auditor as a result of you being a key supplier within that? A SOC 1 or an ISA 3402 report will typically be relevant. And this covers off a combination of areas from entity level controls, core business processes, and IT, as you see in the centre here in terms of key areas of subject matter. However, if assurance is required on non-financial areas or disclosures or other subject matter non-related to financials, this is typically shaped and reported under an ISA 3000. It's basically the wrapper, and we can put a multitude of things within this, typically use this for regulators alike as well. And then we see SOC 2 mentioned here. This is a standard that's become increasingly common and really evolved from the US side of things. I think this probably be a good example for Jason to talk through and just help explain what this is and how we would typically support in this, as it's not just for SOC 2, but we'd have a similar approach across any of these standards. So Jason, apologies, you haven't been allowed to say hello yet. Over to yourself.
Thanks, Fiona. If we go on to the next slide, please. Jason Gottschalk, I'm one of the fellow partners within Digital, focusing really on the trust service principles, but we'll get to that in the next slide. So I think where I want to focus on is really the journey to achieving some sort of independent third-party assurance report. And really, it's almost irrelevant which framework or standard you're going with. It's like a recipe. It follows a predefined process. It's an approach that works for our clients and achieves the right objectives, really. So you kind of start off with the phase 2, which is the readiness assessment. And probably the most important part of the readiness assessment is to understand the overall control framework. So it's basically 3 phases within that phase 2, or 3 steps rather. It's understanding your existing controls aligned to the standard or the framework that you're going to from an independent third-party assurance report perspective. It's understanding where the gaps are there new controls that need to be designed by yourself and implemented, and then going into the final step, which is the final controls kind of planning stage. Now, the nice thing about the readiness assessment is that it gives you the opportunity to get comfort over the controls that you're going to need to attestate against and do that remediation without really kind of committing to whether you're going to actually produce the report, given that you may have some significant remediation that's required. So typically what we find with our clients is that depending on the readiness assessment, the most feasible route to getting an independent assurance report out would be your type 1 type assurance report. And if we focus on phase 3 and phase 4 of our end-to-end story to achieving the independent assurance report, the difference between a type 1 and a type 2 assurance report is really the nature of the sampling. So in a type 1, we're looking at the design of the control in a single instance of implementation, versus type 2, we're looking at sampling over a period of time. So if you take your mind back to the readiness assessment and you have a control that needed remediation and you needed to implement it to operate effectively, typically you wouldn't be able to show for a period of 6 or 12 months any type of ongoing effectiveness of that control. So typically for that, we would start off with the type 1 assurance report, which basically enables you to produce a report quite quickly, providing a type 1 assurance over a point in time for that standard. Whereas if you kind of look forward 6 to 12 months, it gives you an opportunity to embed that control, make sure it's actually operating effectively through the environment. And we would generally come in 6 to 12 months later and do the type 2 assurance. So if you kind of stand back and you kind of say, right, we understand what our market triggers are. We understand what our clients are asking for. We're going to go through a readiness assessment. We're going to understand what our gaps are. We're going to remediate, and we're going to have a final go as to where we stand. Based on that, you could go with a type 1, which is relatively concise in terms of a scope and getting that done. And then as you go forward through maturing, you can look at a type 2 report. So those are really, really your 2 options. And this is really a tried and tested recipe that Fiona and myself talk to clients about and actually go with. So I want to move on to the next slide. So the trust service categories, and this can be wrapped up in a number of different frameworks, but essentially if I look at probably 90% of what clients are driving for at the moment, which is not necessarily to say it's right, it's just what the awareness is within the market and what many of your third parties may be asking for, is the trust service categories. And these are prescriptive frameworks with controls defined, which cover a number of areas. And I would probably say, you know, the majority of the work that we're doing at the moment around the trust service categories covers 4 of the 5 domains. So the processing integrity controls, the security controls, the availability controls, and the confidentiality controls. We're not seeing much drive at the moment for the privacy side of things, but that's going to be an ongoing agenda, and we'll see that increasing as we go through it. So now, you know, typically this can be wrapped up in a SOC 2 type framework or an ISE 3000, depending on where your concentration, but it's a bit of potato. At the end of the day, it's the same thing. It's the categories that are important. And you know, this type of framework is easily understood by most organizations and readily requested by most third parties. And we're seeing a lot of demand for this in the market at the moment. Fiona, I'm going to hand back to you in the studio, so to speak, just to finish off, and to the next slide. Thank you. And you're on mute.
Thank you, Jason. Sorry, we'll just move to some key points. Immediate reaction when people see these are, oh, it's another cost of compliance. My goodness. I'll leave this slide with you, but I'd really just like to highlight 1 or 2 points within it. This, guys, really provides you with there is initial outlay on it, yes, but ultimately you get a real commercial advantage from this. Really enables you to win more work, build more relationships, and as I said, a real license to operate in the market. But a biggie for you from a cost perspective as well is really limits the cost of compliance. I'm sure many of you have been subject to many different auditors or rights to audit being invoked as part of contractual requirements. So you want to avoid that. Do these assurance activities once and avoid auditors traipsing through your door looking for wider types of assurance. So some general points here as well, folks, in terms of just overall hygiene factors, controls resilience, operational credibility, really helping reinforce that within your business and ultimately embedding this key culture of compliance in what you do. But ultimately here, there's a real trust point, which I said from the beginning. You know, the credibility that you can achieve through producing these external reports really brings trust in what you do as a business, which is fantastic overall in terms of that confidence to wider shareholders, stakeholders, and your reputation overall. So just final slide, Shannon, and apologies, we are moving to wrap up now. Very few key points to pick up. If these are going to be on your table, guys, start it sooner rather than later. Don't have that request sitting there. Don't have that need sitting there. It doesn't just happen overnight. So carve out the right amount of time to do it. Also, don't have to get a sledgehammer to these sort of things. One of the key things and skills of our team is helping right size what you need and why, and undertaking it in the most effective and pragmatic way to really manage those costs and expectations. And just finally, I'll use the phrase again, fundamental license to operate in the market. If you haven't heard of such reports, you will do. Look out for them, guys, and really will be instrumental in terms of success and resilience going forward. Thank you. I think it's back over to yourself, Kieran, at this point.
Yes, thank you, Fiona. Thanks, Jason. Sorry we've overrun. We always do. hopefully in the online environment it's less of a pain. But thank you particularly to those attendees who've managed to see us through to the end. We haven't got any specific questions in, which I think I won't therefore keep you any longer. So thanks very much. Thanks for joining us this year. As normal, we'll send around the slides. If there are any follow-up questions coming out of any of the sessions today, please do send them through to your BDO contact. Thank you. Hopefully you did manage to get some interesting information from some of the sessions. As I said, please follow up with your contact if you need any more. So thanks everyone. Thanks very much to the panelists and presenters, and have a good day.